All right, pretty practical question. So a friend of mine from USAA, we're both retired, but she found this video of Charles Ellis, who's one of the most famous people in finance. He and Jack Bogle, really big into indexing. So interviewing him, I'm kind of surprised how young he looks here, because you think of him being kind of been in finance for the last 60 years. But he answers the question. She asked him, "What's the first thing you do?" And what do you think? What was your answer? What's the first thing you do? The first question. Why? What's the biggest thing in that first question?
Right.
What do you think he says the first thing you do? Well, let's see. So here he is.
Because, in figuring it out, 60 years of answering investors' most important questions. So what are some of the most important questions that need answering?
Well, the most important single question is, when will the money that you're investing, when will that money be spent?
Does that sound familiar?
Yeah.
Y'all think I'm making this stuff up. So I didn't pay him to say that because I've never met him. I'd love to meet him, and if I did, I'd get his autograph for sure. Very famous guy. He's written a lot of articles, done a lot of research that's really embarrassed the industry, just showing how horrible of a job active management does. Now, he's pretty extreme. I said, if you're 20 years old, put 100% of your money in the stocks. He's 100% in stocks, and he's 85. He has my theory that he's leaving money for his heirs, so he's investing the way they should invest. But he said, if you have a 10-year horizon, you should be 100% in stocks. That's pretty extreme. He doesn't like bonds, pretty negative on bonds. So anyway, that's his view. If y'all want this, I can email it to you. It's a lot in this class that he's talking about through here. Although the beginning part, he's talking about how the industry's changed over time. He really makes a point that you're competing against really hefty competition. Your chances of beating the market is really slim. He does mention James Simons as one of the few exceptions. So it's like he was watching one of my classes or something. But obviously I should learn from him, but it's interesting how much overlap there are. But he looks pretty good for 85. I hope I'll look like that at 85. So, all right. Another thing I got, there's a Goldman Sachs article talking about the jobs report. If any of y'all want this, let me know. I can send it over to you. But Goldman Sachs keeps cutting its probability of a recession. They went from a 1/3 chance to 15% chance. There are some people who say it's a 60% chance. Why? Because the yield curve is still very, very, very inverted. But they've cut down to 15. Why? Well, they're going to talk about the jobs report in there. And one thing you better get into your first paper, because I think it's pretty important, is this chart right here. Participation rate's the highest that it's been, they see, since 2002, which is 20 years ago. Is that good or bad? That's a really good thing, isn't it? Why do people go back into the jobs market? Because they're confident, they think there's jobs out there. So what does that help explain? The big surprise in the jobs report. The 3.8%, the unemployment rate. Why did it jump from 3.5 to 3.8? Well, because more people are looking for jobs. So that's a good reason why the rate can jump. So that's pretty impressive, right? We dropped so much after COVID, and we've finally gotten back up to pre-COVID levels. So pretty important numbers. So we're looking at that. This would be a good chart to put into your paper. So no recession in next year, or significant lower chance. But those still predicting recession see a lagging impact of the Feds. So the Fed's raising rates. People say when the Fed raises rates, they've never done it this aggressively before, but when they raise rates, they usually do a lot of damage. And we somehow not see that this time. That's pretty important. And fear of more rate hikes. The number of forecasters ditching a recession scenario for a soft landing. So soft landing is what, a 2%, 3% economic growth. It's not, it's not strong, but it's not a recession. Economist Ryan Sweet, I don't know him, but the economy is clearly doing better than anticipated, but there are several noticeable drags that will hit the economy later this year, including tighter lending standards past tightening of money policy and the expected drag of fiscal policy and inventory swings. So they're seeing some negative stuff out there, but we've been talking much more negative stuff all this year. Goldman Sachs strongly disagreed. The long and variable lags of monetary policy will slow the economy. They expect anticipated slowdown from the restarting of student loan payments to be short-lived and other drags from monetary policy. So Goldman thinks the Fed is done hiking interest rates. That's interesting. I saw another article today. One of the Fed governors were saying the Fed now has the ability to talk about not raising rates. So that's a pretty important indicator. So what should be in your paper? You're obviously going to talk about the numbers, jobless numbers, but you're going to probably have to talk about the Fed. You're probably going to have to talk about inflation. You have to talk about the potential for a recession. You're probably going to talk about the inverted yield curve and what that means. You know, there's so many, the participation rate, you always talk about that one. Are you going to talk about particular industries? I haven't looked at the industry numbers, but there was one particular industry that affected a number more than others. So you can go to the Department of Labor's site and they'll give you all of that detail. You don't want to put all that detail in your paper. What you're looking for is there one or two things that really stands out. So that's how you get the critical thinking points. Remember, I grade it of how good of a job you do in making your boss look like a genius. So you're going to give her this paper to help her talk to the CEO. Finding insights other people aren't seeing, that's a big part of that critical thinking. So give me, here's the 50 industries and that's what they did. That doesn't, you know, they added 300 jobs in whatever, be paying, thanks. You know, that's not going to help you. You gotta see, was it healthcare? Was it education? Sometimes this time of year, these are supposed to be seasonally adjusted numbers. So you shouldn't see a big jump in education just because school's starting again. But still, you got to look. I know 1 year education was a drag because the seasonal adjustment was wrong. Because something happened, maybe because of COVID or something, and it caused a distortion. So that COVID and those kind of things can mess up the seasonal adjustments. And so sometimes the seasonal adjustment, you know what a seasonal adjustment is, right? You expect all these education jobs in August, but they adjust that out. You expect certain things because people drive in the summer because of vacation, so they adjust those type of things out. So even with seasonal adjustments, so you can see some surprises that come in because of just the way the numbers are calculated.
One thing I'm going to talk about is how they have like law of job reports like every month, and then the next month they revise it down.
Yeah, the revisions are big. We'll talk about that. You do need to talk about the revisions. This time it was a pretty big revision down.
Yeah, it's not like the past like 13 months in a row that they've had to revise it down by like more than 100,000 jobs each time.
Yeah, you can certainly talk about that. There's some people who think that's an indicator because if you're slowing down, they do the survey in the middle of the month. And if you're slowing down, the revisions are always lower because it's getting weaker and weaker and weaker. So that could be, and then when they're revising up the same way, economy's getting better. And so they do the survey, give you the preliminary, and then they get new numbers. Yeah, so it can be an indicator.
Yeah, I think it's because like when they're calculating the data, they're consistently trying to do the statistics like off trend, because the trend is heading downwards, and because they keep having to revise it, it's clear that they're off trend.
Yep, but I've seen articles, people talk about how bad this report is and how it misses the obvious. And my thought is they're hiring some of the best economists in the world. They're really smart people. They know statistics far better than I do. For me to say they're stupid and know what they're doing is pretty arrogant on my point. Don't you think? So avoid the idiots in Department of Labor, those, you know, always reflect the fact that they were here. How would you do in a debate up here in front of the class against those people? You probably fare pretty horribly. So they're smart people. They may miss some stuff, but if they miss it, they know they're missing it, and they're just leery to making the adjustment yet. So really smart people. So I don't buy the argument that these are bad numbers. No one knows what we're talking about. My guess is they probably do. So there's an article. There's plenty of articles out there. How do you find the articles? You just type jobs report in Google, and all these articles come up. So what are you looking for? You're not volume. You're looking for insights. You're looking for someone seeing something that no one else is seeing. So your paper is very strongly helped by good quotes of knowledgeable people. Right. So Bill Gross, I don't know if he's still talking, but Bill Gross, he's the bond king. If you're talking about interest rates, if the Fed's going to raise rates, what did Bill Gross say? that can be really, really good insights. All right, so talking about this report. So here it actually is. We'll have a quiz on this on Thursday. Maybe it's be an easy quiz, but I did throw in one kind of tricky question in there. So 187,000 jobs. Where were we in the consensus range? Upper end.
Oh, yes.
So jobs essentially were flat versus last month original, but then they revised, the prior month was revised down 30,000. A big number. I still remember, I should go back and find this, but I still remember working at USAA. The jobs number came out at like 90,000 and the stock market just tanked because they were expecting much more than that. The next month they revised it higher than the consensus range and the market didn't care. So that first number was wrong and the market crashes, and then they give the right number, which was a lot better, and the market's, big deal. So these numbers get revised quite dramatically. The GDP number, I saw really hilarious. I think it was Chase Bank or Citibank. He was presenting, he showed all the historical GDP numbers and he showed them all the revisions. And his argument was the original GDP number is a really horrible forecast of the GDP number. Even though it's the actual number, it gets revised so much. And he was showing, they thought it was gonna be 3%, actually came out at 2, and then it came to 4, then it was 3. And he was like, this is crazy. So there's a lot of revisions to these numbers. Not all numbers get revised. The unemployment rate does not get revised. So that number is what it is. So they may go back and historically change their math or something, make it comparable, but that number is not a revised number. So that one's the same. So we went from 187 to 157 revised. The consensus was 170. We actually had 187. So essentially, we went up from last month about 30,000, which is what they cut. The unemployment rate, the market wasn't expecting it to change, but it actually went up to 3.8. Private payrolls is something you talk about. It doesn't look like a big deal here, but private payrolls can be important. There was 1 month where the headline number, the 187, was really negative, and the markets initially sold off. And then what they discovered was it was negative because governments were cutting so many jobs. The private number was actually pretty good, but governments, state governments were just cutting teachers' jobs and all that kind of thing. So private this time, not that big of a deal. It got revised down about the amount that the overall number got revised down. So it's called non-farm payroll. So I guess if farmers cut jobs, you won't notice it, but farmers never quit or, they're never fired. So probably not a big impact. But government can be a big impact. It usually isn't, but it can be. Manufacturing, I don't know why that's on this report. To me, that's not an important number. It might be, but it's not an important number. So go look at the details and see if there's one particular, anybody find an industry that really moved this last time? It can be hospitality. That one should be seasonally adjusted as well, because obviously it's gonna be much heavier in the summer. But healthcare can be, during COVID, obviously. So participation rate, very, very important this time. We jumped from 62.6 to 62.8. That's a pretty good jump, pretty important number. So that can certainly have a big impact. So that's the positive offset to this 3.8. So this is one thing I think is confusing in some students' papers. They'll talk about the 187, and then they'll talk about the participation rate, then they may talk about inflation, and then they'll go back to the unemployment rate. Or to me, the participation rate goes with the unemployment rate. Those are both the household surveys. So don't, think organization-wise where that goes. If you're going to talk about which industry had the biggest jobs, where does that go with? Well, that goes with the payrolls, because that's the number of jobs, and it's the survey of large employers. So if you're going to talk about which industries move, make that part of that 187 discussion. If you're going to talk the participation rate, make it part of the 3.8 discussion. All right. What about earnings? Inflation is a big deal. That's probably something you want to talk about. So the inflation number was on the lower end of the consensus, and it's lower than last month. Those are both positive things. I didn't see a lot of articles making a big deal about that. Average work week, I don't even know how they calculate that. When I was at USA, I had one job, I was working 7 days a week, but I wasn't paid overtime. So I don't know You know, tell I'm working, you know, I was working Friday, Saturday, Sunday, and coming back in on Monday and working just all week long. No one asked me how many hours I was working. My boss didn't care. He never asked that question. He should have, but he never did. So I don't know where that number comes from, where that survey is. So people who aren't paid overtime, I didn't keep track of my hours, so I don't know if that's only hourly workers they're asking or exactly what. So some of these numbers, I'm not real sure where they come from and how they actually calculate them. So interesting report, not as exciting as I would have hoped, although I do think the participation rate's pretty important. How did markets react? Well, unfortunately, it wasn't a big day for markets, but there's two things you want to look at here. First, what did the market itself do? So it was up slightly, 0.18%. But the other thing to look at is how it moved throughout the day. So you can talk about the initial reaction. What was the initial reaction? Much stronger. And then what did it do throughout the day? It kind of settled down to nothing. So the initial reaction was pretty strong. So you can see it comes out right when the market opens. So the initial reaction is they look at that report and that's the initial you go off of it. And then it drops throughout the day. I don't think it was ever negative, but I can't remember. But you show the days range. So it opened at 5. No, I guess it was down, right? Because it opened at 45.30. Well, you have to look at the previous close. Sorry. So what's the difference between previous close and open? So which of those numbers between the previous close and open, which of those have the employment report in them?
Well, the opening price.
The open would, right? Because the report comes out before open. So the previous close and open can be two different numbers. All right. So here you can see there's a pretty big difference of 30 points. That's a pretty significant difference. So the initial open was, oh wow, 30 points. That's like 0.5, 0.6%, right? There's a pretty sharp open. And then the low is 45.01. So it actually was lower than the previous close. So it actually market was slightly down, looks like around noontime or so. The other thing you have to realize though is that entire pattern may not all be related to the jobs report. There might have been other news that came out, so you can't say all of that. But it does take some time for people to figure out what the report is saying. They're listening to articles, listening on TV, reading articles. People are making up their mind and the market's reacting throughout the day. So there's large cap. There's tech stocks. Tech stocks actually were flat for the day. I call that flat. I don't say tech stocks were down. I would say they're flat. 0.02% is not, that's just a rounding difference, right? So tech stocks were down slightly, but flat really. And then again, you can look at the open versus the close. It opened strong, just like the S&P did. Small cap did extremely well. We're going to talk about this. When do small companies do well when large cap are mediocre? Small companies are much more sensitive to the economy than large cap are. So if you have good economic numbers, small cap would generally outperform pretty strongly. Small caps also a little more interest rate sensitive than large caps. So there's a few things going on there. That's a pretty big difference. 1.1% is a really strong up market. So riskier stocks did better than less risky stocks. That must mean there was some good news in that number.
Yeah, the Russell was down. It was down.
Oh, the Russell today? Yeah. Yeah, small cap companies are a pretty good indicator. In fact, you could track these two over time and they'll tell you something. There used to be what they call the January effect, where small companies did really well in January. And I think that's somewhat disappeared, but people do watch small versus large cap. So there's one market that did pretty strong. Oil was up quite a bit, 2.8%. And pretty consistently throughout the day, just kept getting stronger and stronger and stronger. Oil's up quite a bit just in the last few weeks. Gold was up slightly. That's almost flat to me, especially considering how volatile gold is. So gold was up 30 cents or 0.01%. It closed at 1966. Not too exciting. So you may not talk about gold at all. I don't know if that would add much. Is that going to help your boss with the report talking about gold? You might talk about oil because that's a big part of the inflation picture. But gold was pretty boring. Treasury yields, you have to talk about them. They were up how many basis points? 8 basis points. Close at 417. Is 8 a big day? Well, we said one standard deviation is what?
6.5.
6.5. So it's a somewhat big day. So bond prices were what? Up or down? Down. That's a negative day. So what are you going to do with the 1.95%? Don't have it in your paper. You have it in your paper, I count off a lot of points. So don't have that in your paper. It's a nonsensical number. I wish Yahoo Finance would take it off. I mean, it's meaningless. It tells you nothing. So how much were bond prices down? We don't know. Because there's multiple bonds that are 10-year bonds. We don't know. We could look at a particular bond and say, but there's many, many bonds out there. Now, I don't have corporates in here. You could talk about corporates if you wanted to. I didn't look at corporate spreads and see, but who knows? I didn't look at the spreads. It's possible corporate bonds they probably weren't up. They were down, but maybe not down as much as treasuries were. But treasuries are interesting because it didn't shoot up right with the report. It took it a little bit of time to shoot up throughout the day, but then once it shot up, it stayed up. The dollar was rallying, and that's pretty flat, not huge. So a little bit of strength on the dollar. And then I love this chart. Highly recommend you get used to this chart because it's a great chart, and it's possible you have a boss that's never seen this chart. And as soon as you bring it to work and we go, wow, where'd you get that? It's really cool. So where did I get this from? Is it on there? So it's Fin, F-I-N, Viz, V-I-Z, finviz.com. They have this chart, and it is a cool chart. Boy, I hate hitting escape. Because you look at it today, Microsoft is up 1.68%. Everything else looks like it's down. Meta's up 1.3%. But you can actually do year to date. It's a great. So the boxes are the size of the stock in the market. So that's why Apple's the biggest. Microsoft's the second biggest. So the size of the box, I don't know if it's exactly proportional, but it probably is pretty close. And then they show you the performance. So Apple's up 46%, Microsoft's up 39%, Google up 54%. So you can see that this has been another growth year. Growth stocks are doing extremely well. What's down? You see healthcare looks like it's down. Although Lilly's up 52%. Man, healthcare is all over the place, aren't they? You see any major down? Banks are kind of flat. Utilities. Okay, so utilities are somewhat of a bond substitute. So they tend, if interest rates are up, utilities tend not to do well. REIT stocks as well. I don't know where REITs are here. There's not many. There's real estate here. So REITs are probably the same way. Real estate investment trusts are somewhat bond substitutes. So they tend to do poorly when rates are rising. So treasuries are down, a good chance utilities and REITs will be down. But great chart. So you can tell a lot on this chart. Just what's going on in markets. I don't know how far back you can go. 1 year. Looks like 1 year is the furthest you can go. So interesting chart. And then I went to FinViz to their futures just to see on that day, is there anything that really moved a lot? So you can see the thing that's up the most is sugar. Are you going to talk about sugar in your paper? Probably not. I doubt sugar is up 3% because of the jobs report in the US. There's probably something else going on, but I just like to see it to see if there's anything. So sugar's up 3%, coffee's down 2%. I do micro lending in Costa Rica. We do sugar lending and we do coffee lending. So our sugar farmers are doing really well and our coffee farmers are doing really badly. I don't know where bananas are. They don't have bananas in here. You notice commodities dominate the outsides of this, and that's because commodity prices are much more volatile than stock prices and other types of prices. Now here, the percentage change here is the actual percentage change in the bonds. So when they say the 10-year, let's find the 10-year. The 10-year is down 0.45%. They mean it's down 0.45%. It's down about 0.5%. That's the particular 10-year treasury that they're using. And if you use their site, they'll actually give you the price of the treasury, but don't put that in your paper. Telling your boss a treasury's trading at 98, that's just meaningless on bonds. It means a lot when you're talking about Apple. When you're talking about bonds, telling your boss what a bond, a kind of generic treasury's trading at doesn't help you. But another cool chart, this chart might be helpful if it tells you a story. I just don't think this one tells you a story. If all commodities are up, that someone gives you an inflationary type of information, but you're not seeing that. Some commodities are up, some are down. You know, oil is probably pretty high up there. There's oil right there, up in the second highest, right behind sugar. Cotton's up there, crude oil, Brent, and WTI. So all of these are out there. I'm not saying use all of these in your paper. I just dump everything, and then you've got to figure out what's important. And there's probably some other ones you could bring into your paper. So start writing it. We'll have a little quiz on Thursdays. But you see what you got to do. You got to explain what happened. I'm giving you like 30 days, and your boss will give you like 30 minutes. So I'm giving you a lot of time. But this is what you're looking for. You can put your opinion in it, but your boss can be much more interested in people who have 20, 30 years experience opinions. So quotes are really helpful. Charts that they're using, charts that you can find, you know, go out there and read articles and find some great insight to what's going on. One of my favorite economists, I don't think he's published here recently, but Hoisington Asset Management. Lacey Hunt writes this economic view. So his last one, he says second quarter 2023. It's probably a few. So we're looking for his third quarter, and he hasn't written that yet. But really, really good. I would recommend you read his stuff. Smart guy. It's Lacey Hunt that writes them. Hoisington owns the firm, but Lacey Hunt writes this. He's an economist. Very aggressive portfolio in Austin. They bet on one thing, and that's on interest rates. They don't buy corporates, they only buy treasuries. He makes huge bets on the direction. Almost no bond manager does that. They're the exception. They bet on the direction of interest rates. So he has to get that right. So he writes a lot about the Fed, a lot about inflation, a lot about the supply of dollars, the supply of money, those kind of things. Some of it's pretty complicated, so you might have to ask your economics professor. But Lauren, you have a question?
In terms of quoting people in the paper, wants to see like a type of website update, if you just want to use that in.
Well, we're talking about paper that's internal to the firm. So sourcing is not as important. Your boss doesn't need that. The assumption is going to be, I'll maybe let you cheat a little bit, but the assumption is going to be whatever you're quoting, you saw it on that Friday. I think the Goldman Sachs article came out a day or two later, so I won't be real picky, but most of your quotes are going to be on that Friday. So you don't really have to give the date because it's pretty obvious they just said it. You're not going to quote someone from 6 months ago. So I gave you the Economist article, that kind of thing. Yeah, you want to quote because the date's real important. I had a boss that if I didn't put the date that something was said, he would just rip it off. I mean, literally, he ripped. I found that going in his office, I put the paper behind my back because if he saw it, he'd grab it and start reading it straight. But if I say, it's like, when the person said, did they say it 2 weeks ago or 7 months ago? But since your report is really written on Friday, we're going to assume all of that was said on Friday. So if it wasn't said on Friday, that's when you got to put a date in there. Yeah, Lacey Hunt. One thing I love about his writing is he has charts that you won't find anywhere else. He has really great insights. And what he's trying to tell you is, which is really what you're trying to get to your boss, is the market thinks this, but they're wrong because of this. That's what your boss wants. All right. If you can say insight as a stock analyst, that's the best thing you can say is say the market thinks this, but this is why I think they're wrong. Then your boss is saying, okay, I can make money off of this. People are getting it wrong. It's mispriced. That's what you're looking for. So those are kind of great insights your boss is looking for. Plus, you're trying to make her look like a genius. So she can go and talk to the CEO and says, yeah, the market's getting us wrong. Makes her look a lot smarter. And she'll definitely appreciate that. All right. Any questions on any of that? This is a good paper to put out there on LinkedIn. It's a pretty topical paper. Shows you know you can talk economics, which is a big part of finance. What economics classes have y'all had? I've already had money in banking, or are you taking it now? quit taking it now. It's a really, really important class. So you do micro, macro, and money and banking? Or is money and banking your macro?
No, big background.
Y'all do nine hours of economics? No. Pretty important stuff. The micro, it sounds really important, but we don't usually use it that much in finance. The macro is really important. How does the Fed act? You know, what is the multiplier effect and those kind of things? And that's what Hoisington writes quite a bit on. He actually thinks the multiplier is negative right now. His belief is once debt gets to a certain level, more government spending actually slows the economy down, doesn't speed it up. And he has a lot of data to show that. Obviously, people disagree with him on that, but your eco classes are pretty important. All right. So we're up to convexity. Does anyone remember DC cut psi? D is duration. C is convexity. C is credit. U. The same U as under stocks. Yeah, US versus non-US. T, taxes. T for taxes. S, structure. And I, inflation. And then on D, we said duration. How do we define it?
All the weighted average.
Weighted average time to maturity using discounted cash flows as your weights. R, it's the measure of interest rate risk or price risk for bonds. How many categories were there? Three. What were those?
Short term, intermediate, and long.
Short term, intermediate, long term. And your strategy, expect rates to rise. Shorten duration, expect rates to fall. Length and duration. All right, so you'll kind of see the model there. These are the kind of things I expect in an interview, you just know off the top of your head. So you don't have, no, it's got to be like rates falling. No, I'm going to lengthen duration. All right, so convexity is the toughest one. Really hard to talk about, mainly because it gets into the structured debt side of it. So duration is a linear function. It assumes interest rates and bond prices move in this real linear way, but they don't. They move in a convex way. And so I showed y'all this spreadsheet. I'm going to show you again this website. That Roberto built for me. So we'll do a 30-year bond, 0 coupon, 4% yield. So the blue line is what the bond's price would be if duration explained everything. And it does a really good job if interest rates don't change much. But if interest rates change a lot, it's really pretty bad. Why? Because of that convexity formula. Why? Because when interest rates fall, duration it lengthens. When interest rates rise, duration gets shorter. So duration's changing. So it's not a straight line. We call this when the green line is higher, so how the bond price actually moves, when that's higher than duration, we call that positive convexity. This is also positive convexity. So positive convexity is you're always better off than what duration would say. So this bond has a lot of positive convexity. It's a 30-year 0 coupon bond. 30-year 0 coupon bonds have a lot of positive convexity. So when rates fall a bunch, you get a huge windfall. They're up. That's why long treasuries are up like 60% in 2008 because of this huge convexity effect. Shorter term bonds, you almost can't even see the convexity. It's still positive, but it's hard to even see it. So if you're doing a 2-year bond, you don't need to mess with convexity. Duration's going to tell you everything you need to know. But if you're doing a 30-year bond, you better know what the convexity is. Extremely important. I think I gave y'all the spreadsheet that he built this off of. If not, I'll have to remember to put it out there. But I have it all built in Excel. It took me forever to find a convexity formula because as interest rates change, duration changes, but so does convexity. So everything's moving. So the convexity formula is an approximation. If you were to see So the spreadsheet I have, it has my approximation of convexity versus the actual bond price. You're gonna see my approximation is really pretty close. Gets you there, but it's a massive formula. So would you memorize? You should know the formula for duration. We'll see that later in class. It's a pretty easy formula. Not many people have the formula for convexity memorized. It's just a massive, massive formula. But you can build it in Excel, so I'll have to get you all that Excel spreadsheet. But he took that spreadsheet and built this Python program so you could do this online, which is pretty impressive. So a 2-year bond has a duration of 1.9 years. Why is it 1.9 and not 2? Because duration is the weighted average time to maturity. And you're getting those coupon payments at 6 months, 1 year, 18 months, and at 2 years. So all your money doesn't come in 2 years. Some of it comes early because it's paying the coupons. So that's why the duration is 1.9. The 30-year bond, its duration is 17 years. It's not even in the 20s. It can be very, very, very different. Look at its convexity. Its convexity is 400. The 2-year bond's convexity is 5. It makes a big difference. All right. I give you the formula in the notes for how convexity works. Big convexity, what they do is you're taking the square of it and taking half. So you need a lot of convexity for it to mean much, because of you're taking, square. When you square a really small number, it becomes a much smaller number. So you square the change in yields times convexity divided by 2. So it doesn't have as big of an impact on the price of the bond unless rates move a bunch. When rates don't move much, the convexity formula really keeps that number small. But when you have a lot of convexity, it can be pretty material. So when does this matter? So the subclasses on convexity, there's only 2. They're bonds with positive convexity, bonds with negative convexity. So I just showed you bonds with positive convexity. Where in the world would a bond with negative convexity come from? Did y'all read the class notes? Where does negative convexity come from? Comes from the word options. When you give the borrower options, when they have the right to do something, you can cause convexity to go from positive to negative. Now, what options does the U.S. government have? I think I mentioned Trump scared the markets when he was president, because he talked about the U.S. government paying off all its debt as interest rates were so low. And the only problem with that is you can't do that. It's illegal for the U.S. government to pay off its debt at par. They can go out and buy their debt, but you got to pay what are the market prices. They can't say, hey, U.S. Treasury is trading for 130. We're just going to pay you 100 for it. The U.S. government can't do that. If they did that, it would completely disrupt. I don't know what the world would do this. But that's what Trump was thinking. It's kind of implied. Maybe he didn't mean that, but that's kind of what he was thinking is, hey, you know what? Let's just pay off all our debt at par and we'll just go out and borrow at 1% because rates are so low. It's like, no, you got these bonds paying 6%. You can't just pay that person par. You got to pay them $130 because they got a bond paying 6% when market's only paying 1%. So you can't do that. But with mortgages, you can. If you borrow on a mortgage at 7% and mortgage rates fall to 2%, what are you going to do? You're going to refinance. So you as the borrower have the right to refinance. When are you going to refinance? When rates are in your favor or when you're in your disadvantage? In your favor. You're never going to do it. I borrowed at 4%, but mortgage rates are 8%. And this poor bank, feel sorry for these guys. I'm going to refinance at 8%. You're not going to do that. That would be stupid unless you're just a really, really rich person. But yeah, you're going to do it when it hurts the bank. When it helps the bank, you're not even going to think about doing it. So there's a lot of people who wish they refinanced back in 2021 because now they're like stuck, a lot of people stuck in their houses right now, right? Because if they sell their house, if they have a new mortgage of 7-8%, yeah, they're kind of stuck. So that's what we call an embedded option. An embedded option, the bond has an option. Usually the option goes to the borrower. There are some options to the lender. There's what we call puttable bonds. We're going to ignore those entirely. But there are usually, that's where the bank comes in and says, you know what, we want you to pay your mortgage off today. That would be a pretty bad mortgage, wouldn't it? And we decided we wanted to pay the entire $300,000 a day. We just don't like your mortgage. You're not going to do that. But you as a borrower do have the right to just pay off the entire mortgage all at once if you want to. So that's what we call prepayment. And in finance, it's actually called prepayment risk. It's the risk that someone's going to prepay their loan at the worst possible time. You loan to them at 7%, now interest rates are 2%. They're going to give you all this money back. And now you got all this money. You were making 8, you got all this money, and all you can do now is reinvest it 2. You're pretty upset. You wish you could still be getting that 8%. So that's called prepayment risk. So this is how this gets so complicated. We're going to talk about stock options later in the class. Stock options are pretty complicated. Security has a lot of math behind it, option pricing models. These type of bonds are actually bonds with an option, the same option we talk about stock options. So these are bonds that are, you have a bond, but you also have an option embedded in it. You have all the complicated math of options on top of just a normal bond. We call it a straight bond, and then we put an option on top of it. So a treasury bond doesn't have any options. The government has to pay you when they said they're gonna pay you. If you got a 10-year bond, they're gonna pay you coupons every 6 months, and then they'll pay the rest at maturity, the principal at maturity. But these bonds have an embedded option. And it's when you give someone an option, they only execute the option, just like with stock options. They only execute it if they're going to come out ahead. They're not going to execute it if they lose. So it's a one-sided bet. So option prices, well, I won't get into that yet. So you're essentially getting a regular bond without an option, and your mortgage bank. This is, man, this can blow your mind. Your mortgage bank is actually selling you a call option. Now, y'all know options yet, maybe not. But which is riskier, buying options or selling options? How much can you lose if you buy an option? 100%. How much can you lose if you sell an option? Unlimited. If I sell an option on Apple that I can sell Apple for X dollars, no matter where it goes, I have to sell it for this price. There's no limit. I'm going to sell the stock for $100. And it's right now at $90. Then it goes to 100, 110, 120, 130. I have to sell it to the person for 100. So I have to go out and buy it for its current price and sell it to this person for 100. There's unlimited loss. If I buy the call option, the worst that can happen to me is I'll lose that option. So a bank, when they loan you money on a mortgage, they're actually selling you an option. That's a pretty risky thing to do. You're actually buying an option. So you're actually paying for an option. We'll talk about how much that costs you. So the borrower is going to execute that option when it's in their benefit. That's called refinancing. So they can refinance at a lower rate. They're going to do that. Now there's some fees banks add in. Some of it I think is unethical. Some of y'all work in this industry. I think the mortgage industry is, I don't know it as well as the investment and insurance industry. I think those two industries are pretty unethical. I think the mortgage industry, especially title insurance, I think is a fraud, but just my opinion. But so there's reasons not to refinance because you have all these costs you're going to pay that you wouldn't normally have to pay if you just kept where you were. But usually if rates have fallen enough, that lower interest rate is going to more than offset all those extra costs you got to pay. Now, here's the thing that makes it real important to our discussion is how option prices react to volatility. If I buy a call option on a stock, that call option becomes more valuable to me if the stock gets really volatile. So I say, hey, I got the right to buy this stock for $100, and its volatility was 2, and now its volatility is 8. Well, that's going to be really valuable to me because it's much more likely that stock's going to really shoot up in price. I get to buy it for the lower price. So options love volatility if you're doing what? Buying the option or selling it? If you're buying the option, you love volatility. What do you think about volatility if you're selling the option? You hate it, right? So option prices rise when the underlying risk gets more volatile. What's the underlying risk here? Is interest rates. Option prices rise on these type of mortgages when interest rates are volatile. Remember, the lender is selling the option, which means volatility does what? harms that price. Right? So mortgages, if you're the lender, volatile interest rates are your enemy. If you're the borrower, it's great because you might get a chance to refinance at a low rate. But if you're the lender, you hate volatile interest rates. Okay, so keep that in mind. Selling options is bad when interest rates, that word right there is really important, become more volatile. Right? I do count off of this on the exam. We're talking about volatile in the future. If rates are really volatile right now, you might be in your favor to sell the option because they're gonna, you can get a really good price for them. But we're talking about your expectations. We're gonna ignore convertible bonds, but that is another option. There are bonds that convert from bonds into stocks. I'm gonna ignore that. That's a whole world of finance. You could spend your entire career just on that and make a fortune. But that's not my world. But we're going to focus our attention on callable bonds and mortgage-backed securities. So callable bonds, so IBM goes out and borrows $1 billion. The lender says, here's $1 billion. And they say, oh, IBM, we're going to loan it to you at 7%. But by the way, IBM, if you want to pay off the debt early, we'll let you pay it off starting in 2 years. And so when is IBM going to pay off that debt? In 2 years, so they borrow at 7%. In 2 years, interest rates are 8%. What does IBM do? Do they pay off the debt early? No, what do? They just keep paying 7%. What if in 2 years, interest rates are 4%? What will they do? They'll pay it off and go out and borrow. They'll borrow 4%, pay off the debt, and they'll do that. Now, there's a good chance the lender's going to say, IBM, you can pay off the debt in 2 years, but you got to pay us 102. You got to pay us an extra 2%. Then what does IBM do? Well, they sit down and do the math and they figure out if it's in IBM's benefit to pay it off early, what do you think they're going to do? They're going to pay it off early, right? They got a really good finance department. They're going to know this extremely well. So there may be a lockout period where they can't pay it off early, and there may be a premium they have to pay if they pay it off early. They know all of that math. So how could you study this and really get into it? Well, there's a term almost no finance majors undergraduate know. So if you want to give yourself an advantage, look up YTM. And YTW. What is YTW? Well, YTM was yield to maturity. What is YTW? Is it up there? There's a YTWL exercise. I don't know what that is. Yield to maturity is the yield if no one prepays. Everybody just holds the bond. That's yield. That's essentially your discount rate for that bond. So yield to worst. All right. Did you find it or did you know it? Okay. Yield to worst. So what is yield to worst? A very, very important number. Well, if you've got that debt with IBM and you're 1 year in and interest rates are falling, what yield to worst is what if IBM were to prepay this bond at the worst possible spot for the lender, what would that yield be for the lender? That's what yield to worst is. Is that an important number? Yeah, because you as the lender, that's probably what you're going to get unless rates change, right? Because you know IBM is going to execute and do whatever's in their best interest. That's what yield to worst is, all right? Pretty important number. And if you look up yield to worst in Wikipedia, all kinds of stuff will come up, including things like callable bonds and convexity. This is Investopedia. I don't like Investopedia. So Investopedia you go to first because it's overly simplified, and then you go to Wikipedia to get the rest of exaggerated stuff. Too much. There's yield to maturity. I don't see yield to worst in here yet, but where did yield to worst go? Yield to worst, Wikipedia. There it is. No. Well, it's got to be in there somewhere. It's all over the place. So let's look at Investopedia. Yield to worst is a measure of the lowest possible yield that can be received on a bond that fully operates within the terms of its contract without defaulting. That's exactly what I said. I said it probably in fewer words than that, but yeah, I mean, IBM's going to do whatever's in its best interest. yield to worst is what the investor's going to get unless rates change. So if they have a lockout period of 2 years, 1 year from now, the yield worse, it can change, right? Because interest rates can still change in that lockout period. And the yield to worst might be that they refinance it in 4 years because of that premium. That premium declines over time. So that yield to worst can still change. Because they may not refinance in 2 years, they may wait to 4, but then interest rates go against them and they were better off having that. So yield to worst can change. It's not a fixed number because interest rates keep changing. So the yield to maturity and the yield to worst on a treasury security is essentially the same. I mean, there's a little bit of difference because you can reinvest the coupons and interest rates change, but for the most part, you don't talk about yield to worst on the treasury. So don't do that in an interview. You always calculating the yield to worst on the 10-year treasury. They would probably say this person either discovered some new theory in finance or they don't know what they're talking about. So yield to worst is a strange thing to talk about. So when do you talk about yield to worst? There has to be what? What did we just say? Has an embedded option. There has to be some embedded option. If there's no option, yield to worst, yield to maturity are the same. Because they have to keep paying those cash flows exactly per the contract. Yield to worst and yield to call are very, very similar. The yield to call is that date where the person can actually start calling the bond. It's that first date where they can start. So the yield to worst can be different depending on how much that premium is, but essentially the same type of concept. I wish Wikipedia had something here. They probably have a yield to worst in there. There it is. Yield to worst when a bond is callable, puttable, exchangeable, or has other, what word they need right here? Other options. The yield to worst is the lowest yield of the yield to maturity. Yield to maturity is essentially that discount rate. If I went through every possible scenario for this bond, what would be the worst case yield there would be? And that's exactly what you're going to get if interest rates don't change. Because you know the borrower is going to do whatever's in their best interest. So if interest rates don't change, you're going to get the yield to worst. So it's a very, very important number. This is really cool stuff, isn't it? You can see how you can really deep dive into finance on this. So that's a callable bond. We're not going to talk much about callable bonds because I want to get into the cooler one, which is mortgages. So mortgage-backed securities, MBS. So I don't, have y'all heard the term asset-backed securities? That sound familiar? Have y'all had that in the class yet? Asset-backed security. So banks do a lot of lending, but they don't like to. So they get it off their books as fast as they can, especially mortgages. Most banks don't want 30-year debt. It's too long-term. So what they do is they take all their mortgages and they stick them into a trust. And they borrow against that trust. So you essentially get all your mortgages today and they sell that trust out to the market. You may know what that's called. It blew up in 2008. Y'all heard the term shadow banking? So shadow banking, it looks like banks are doing mortgages, but they're really not. It's really the capital markets because the banks, they're just facilitating and servicing the debt, and they're selling it off into the markets as fast as they can. It was funny at USAA, our CEO, he was complaining because our bank wasn't growing fast enough. And I was looking at the numbers and I was thinking, USA's bank was probably the fastest growing bank in the US, but why didn't it look like it was growing? Well, because they were taking all those assets and they were securitizing. They were throwing them out into the market. They were securitizing $8-10 billion in assets almost every year. Did they talk about that while you were there? Huh? Yeah, it was the CEO 3 CEOs ago. CDO. No, the CEO of the company. Sorry, we'll talk about CDOs as well. But no, the CEO of the company put up a chart and say, why isn't our bank growing faster? And I felt like saying, because they keep selling all their loans to the market. If they did $10 billion in auto loans, they were securitizing $8 billion in auto loans. Very few of them were staying on the books. If they did $10 billion in credit card loans, they were shipping them off to the market. They weren't keeping them. So that's pretty common. It's called securitization. Securitization means you take something that's not a security, like a mortgage, and you convert it into a security that the capital markets can buy. So mortgage-backed security is a bond. It's very liquid. It's almost as liquid as treasuries. It's a very, very liquid security that you can buy. There are mortgage-backed security mutual fund portfolios that you can buy. The USA used to have a Ginnie Mae, which is a mortgage-backed security, Ginnie Mae mutual fund. So they're out there. But that was just the shadow banking. Is it looked like banks were doing stuff, but they really, really weren't. They were facilitating. They still get a servicing fee, so it feels like your bank is still the one doing your mortgage, but in reality, they shipped it off to somebody else. They do it via trust, so they stick all these bonds into a trust, and then that trust system, what it does is it goes out to the capital markets and borrows money. So the trust might be $2 billion, may have hundreds of mortgages in it. It goes out and borrows, say, $1 billion. It then gives that $1 billion to the bank. And then it tells the borrowers, whatever cash flow we get on this mortgage back, that's what we're sending you. So another term for that would be, you'll see that down here. Have y'all heard that term before? Pass-through securities. So what is the trust saying? Hey, we got all these mortgages from the bank. You give us money, we're going to give that money to them. So essentially the bank gets all their mortgages today paid off. And then we're going to borrow that $1 billion and we're not going to pay you back some fixed rate. We're just going to pass through to you whatever the mortgage payers give us. So if the mortgage payers prepay their debt, guess what the trust does? They send that to the lenders. So when interest rates fall, those people who bought those mortgage backs, they're going to get a bunch of cash. They may not want it because interest rates have fallen, but they're going to get a bunch of cash. So that's the prepayment risk. The originating bank, that's the bank you actually borrowed money from. The originating bank doesn't want that 30-year mortgage on their books, so they're going to stick it into a trust and get rid of it. And then, so no telling where your mortgage is. If any of y'all have mortgages, no telling where it is. Your bank, it still feels like it's at your bank because you're still paying your bank the mortgage. It's just getting passed on to the trust. Why can you securitize? So Emmanuel mentioned CDO. So we have mortgage-backed securities. Those are mortgages that are packaged up. You have auto loans. So you can securitize auto loans. Very, very different mortgage backs. You got a 5-year auto loan. Are you going to refinance that, do you think? Pretty rare, isn't it? You might say, well, I borrowed at 5% and interest rates are now 3%. You could refinance, but the loan's only 5 years. It's not going to save you all that much money. But if you got a 30-year mortgage at 6%, now rates are 3%, yeah, it makes a lot of sense because you save a lot of money. So auto loans don't have a lot of prepayment risk. What about credit card loans? Well, that's floating rate, right? They change that rate every month. So there's no prepayment risk. You're not going to like, I'm going to pay off my credit card, refinance. You're not going to refinance your credit card because every bank can have the same rate. You know, it's a moving rate. So the credit card loans are sold off as well. So Emmanuel said CDO, and you may know what the D stands for. Did they tell you the D? Collateral's debt obligations. So collateral's debt obligations are other debts that banks have. A lot of them are business loans, so they're going to stick into a trust and sell those off. You have CLO, collateral's leverage obligations. I mean, just all different kinds of debt that banks have. They just securitize them and they sell it off to the market. And it is a alphabet soup of letters. So MBS is mortgage-backed securities, but there's also CMOs, PPOs, POs, IOs. There's all different types. So what the market does is that we'll talk about this when we talk about structured debt. What the market does is it takes all these bonds. There's hundreds of them, and they just start parsing them out. They say, do you like risk? No, I don't like risk. Oh, I'll tell you what, I'll create this bond. So if interest rates fall and there's a lot of prepayments, we'll protect you from some of that prepayments. And you say, oh, that's great. Well, to do that, we're going to have to give you a lower yield. You say, that's fine. I don't want to get a bunch of cash when rates are lower. So what does that trust have to do now? They have to now find investors that want a higher return that are willing to take all that prepayment risk. So they're going to take a bunch of risks. Someone else doesn't want the risk. What are you doing? What is Wall Street doing? It's called financial engineering. They're just taking all these cash flows and they're divvying up to different investors. The people that don't want risk, they say, okay, we'll protect you. People who want risk, hey, you're going to take a lot of risk, but we'll pay you a whole lot more. That's what they're going to do, and it's pretty amazing. Most of this came out of the 70s and 80s. It's a fairly brand, you really needed computers to be able to do this. It's hard to do this with slide rules. So it's a pretty quantitative part of finance. But that's where the banking market is. Mortgage-backed securities have very negative convexity. So why is it? You think about the treasury, interest rates fall. You got a treasury paying you 5% and rates fall to 2%. You're really happy you're getting that 5%. So as interest rates fall, your bond price shoots up. But what if you have a mortgage? You got a mortgage, 5%, interest rates start falling. The price starts going up, but when does it stop going up? The person refinances. So you're kind of capped. You can't go any further. So the price doesn't keep going, it just stops. Why? Because that bond is at par at 5%. As interest rates fall, the bond price goes up, but they can always pay off at par. So you loan them $100,000, they'll owe you $100,000. They're paying you 5%, but now rates are 2%. They're not going to pay you $130,000. That's what the treasury have to do, right? If the treasury wants to pay off that debt early, they'd have to pay $130,000. But what does the mortgage you get to do? They get to pay off the debt at $100,000. So the price can't keep going up because they're just going to pay you par. And so think about that line with the duration. Remember the convexity went like this. With the mortgage back, it just turns left and goes straight. So you have negative convexity. That's called prepayment risk. You have the same risk when rates rise, because what happens with rates rise, someone has a 6% mortgage and their mortgage is say $1,000 a month, but they pay $1,200 a month because they want to get the mortgage paid off early. But now interest rates have risen. They're paying a 5%. They're paying a 5% mortgage, and they can go buy bank CD for 7%. They're not going to keep paying that extra $200 a month, are they? What are they going to do? They're going to take that and put it in a bank CD. So that's called extension risk, right? So those are both there. We'll talk more about this. Pretty complicated stuff. We'll talk more about this next time. So this is kind of you have an interview today. It's kind of impressive to know the exact number. Yeah, 187,000 jobs. That wasn't great, but it's not bad. You know, that's off the top of your head. That's pretty impressive. So first one, 3.8%, 187,000 jobs. Jobs expected was what? 170. 4. Okay. Revised lower. Private payrolls, 179. If you didn't know that one, you can kind of guess. It's extremely rare for private to be higher than total, except for that time when the government was cutting jobs, which isn't the case, which is rarely the case, right? But all right, the S&P. See, it rose. B's not wrong, but this is a bizarre way of saying it. 10-year Treasury, B. Participation rate, B. Now this last one, that's an actual, so all 4 of these are actual headlines, but one of them wasn't for August. All right, I took one from several months ago and I just revised it and put the word August in there. So that one's true. Forges on, it kind of implies, you know, still positive, but Forges doesn't it didn't zoom on, it forges on. So it's kind of, you know, going through the trenches, kind of losing your steps. Participation rate highest, we talked about that, highest since 2002. So that's certainly true. Unemployment rate, 18 months high, but for good reasons. Why? Because the participation rate is high. So that makes sense. So this one doesn't make sense. What's the problem with this statement? There's only one word that's really
Strong.
well, strong, but to me, recovery doesn't make sense. We're not in a recovery because the jobs report's been strong, the economy's strong. So we're not in a recovery. What people are thinking about is we might go into recession, but it's hard to say we're in a recovery because we didn't have, you know, we didn't really have a major sell-off. So so that one's a little bit off. All right, so that one's the one that's wrong. All right, good. Guess I'll save it. All right, and then the paper's due September 30th. So what we'll do the week before, the week it is due, probably on the 26th. So start thinking about this. we can find a volunteer that has a good draft, I'll grade their paper in class, so then y'all can see how I grade. We just need a volunteer. Last semester, the same guy volunteered every single time. So he was pretty confident. And he would come to me first for comments and then he'd do it. So he didn't want to just go cold. So, you know, take the chance, go for it. But you got a couple weeks here. All right. Did I miss anybody? Let's see. Say hi. Yes. Fez. Eric. Mark. The other Mark. You're Mark Rojas, right? Oh. Okay. I'm gonna have to get y'all. Mark Rojas is not here. Or can you, when do y'all change your first names? Just joking. Just for the class. Eric. Jade. See her. The other Mark. Alejandra. Laura. Valerie. All right. All right, so we'll make good progress through DC Pet's eye. But again, what is DC Pet's eye? Let's keep remembering it. D is duration. So duration is it's a measure of price risk, measure of interest rate risk, the weighted average time to maturity using all cash flows, not just the maturity cash flow. All right, how many subcategories? 3. Remember those? Short-term, medium, long-term. That's what Vanguard came up with. If you go to the Vanguard site, Fidelity site, T. Rowe Price, they have short-term bond funds, they have intermediate-term bond funds, they have long-term bond funds. That's just the standard. I've seen some that are super short-term bond funds. It's like, it's not quite money market, but it's not quite short-term, but it's excessive. I've never seen one that's like super long-term bond funds. So that doesn't exist. All right, and then your strategy. The key on the strategy, what if I say rates are rising, so I want a shorten duration? What's wrong with that comment?
They already rose.
Yeah, if they're rising right now, it's too late. Okay, so you have to say, if I expect rates to rise, I want a shortened duration. If I expect rates to fall, I want a lengthened duration, right? So that expect is really important. All right, and then what's the C? Convexity. So there's only 2 there, right? Most bonds have positive convexity, but there's some bonds with embedded options that can have negative convexity. All right. And so those are the only 2 categories. What is convexity? That's the tough one to define, but it's essentially that second derivative of the change in price, the change in interest rate, because duration changes as interest rates change. So convexity captures that. And we'll talk about the strategy. All right. So we'll get to the other ones here pretty soon. So this is where we got with the mortgage-backed securities. I'm discovering the mortgage market. You read my blog on the investment industry, I'm pretty negative. There's a lot of ethical problems. Those taking my life insurance class, I'm really negative on that industry. Now I'm involved with the mortgage industry because I've got to reprice a mortgage that I'm responsible for as a treasury. I'm amazing how unethical that industry is. I don't know any of y'all involved in title insurance. It's such a scam. Boy, what a scam industry. If you're involved with it, I'm sorry, I just insulted your parents or whatever he's involved. But just such a horrible industry. It's an industry that only the banks benefit from, but they shift all the costs to their customers, and it's grossly overpriced by not 50% or 60%, overpriced like by 500, 600%. It's a horrible industry. So I'm not a big fan of the mortgage industry, but it is an important industry. It does provide debt to homeowners, but it's an interesting debt in that they allow the borrower to repay at any time without penalty. That's pretty amazing. In fact, our mortgage even says that you can prepay your debt anytime without penalty. So that's pretty cool. You can do that with your auto loan as well. You just pay it off early. So it can have very low and usually negative convexity. Why? Because when interest rates fall, people reprice, they refinance, not at, rates fall, you would think the mortgage value would go up, but it can't go up because it goes up to 130 and you can pay it off at 100, you're not going to get to 130. So since you can always pay off your mortgage at par at 100, it can't keep rising. Treasuries, as interest rates fall, it goes from 100, 105, 110, 20, the price just keeps rising. Mortgages can't do that. And so remember the duration line, mortgages are going to turn left earlier because you're kind of stuck there at par. When rates rise, people make fewer extra payments and they say, well, I'm paying off an extra $200 on my mortgage. I'll just stick it in the bank CD. I'm making more money there anyway. You have to be careful. I was on the board of the USA Credit Union when they had one. I forget what it's called now, United SA or something. But anyway, I called the president of the credit union. I go, John, do you know that your CD rates are higher than your auto loan rates? And I'm on the board. And like, why are we paying 7%? They're paying 7% on their 5-year CDs. Why are we paying 7% on our 5-year CDs and charging 5% on our auto loans? How do you make money as a bank? You're paying people 7 and you're bringing in 5, negative spread. And his answer was, well, no one's buying them. And I said, well, I am. So just so you know, it's like, so they had this ridiculously high rate. Could I get out ahead of that of doing an auto loan at 5%? After tax, you're probably going to lose because auto loan interest isn't tax deductible, but the 7% is taxable. So, you know, you couldn't make up for it, but still 7%, that was ridiculous. So when rates rise, borrowers will probably not prepay as much, probably go buy something else because they have higher interest rates. Mortgage backs are often free of credit risk, especially the way Fannie Mae and Freddie Mac sets them up. So when Fannie Mae and Freddie Mac, have y'all heard of those firms? FM, I can't remember what they all stand for. But yeah, there's much older. But and then Ginnie Mae is full faith and credit U.S. government backed. So those are credit risk. Freddie Mac and Fannie Mae, you might think, well, they're dangerous because they blew up in 08, but it wasn't the mortgage banks that blew up, it was the actual companies that blew up. So they're fine. There's a lot of debate whether the U.S. government's going to step in and rescue their mortgages if they had some issue. But so far, Freddie and Fannie are considered pretty high quality. So where does the risk come from? It comes from this convexity. So here's, boy, if you can understand this, you're way ahead. How many of you are going to take John Dewey's fixed income class? Have y'all talked about that this next semester? So he'll probably get into OAS quite a bit. It's a good term to look up on Wikipedia. So let's take Ginnie Mae. Ginnie Mae is a mortgage-backed security. So you collect all these mortgages from banks. The federal government says, hey, if there's not enough money, if enough of the mortgages default, causes the loss, the U.S. government is going to step in and make up the differences. So no credit risk. It's the same credit quality as a U.S. Treasury, and yet it has a pretty significant spread over U.S. Treasuries. And this sounds like a really good deal, but it's not, because you're not getting paid that extra yield because of credit risk. You're getting paid for it because of prepayment risk, because of that negative convexity, which can be really dangerous. If you got it, your grandparents are like, wow, this Treasury portfolio is paying 4%, but Ginnie Mae's paying, 4.5%, 5%. Why don't I just stick my money in there? There's no credit risk. Well, they're going to be really surprised if interest rates fall and people are prepaying, and they're like, wow, and they're getting that 4.5% return. So, yeah, these bonds have what's called a spread, and that spread is broken into two pieces. There's the credit spread, and there's the OAS, and then there's the option spread. All right. I'm just going to look this one up because the last time I looked, Investopedia had it wrong. So you can type in option adjusted spread and see if Wikipedia comes up first. Is that Investopedia? Let's say what they say and see if they have it right. The option adjusted spread is the measurement of a spread or a fixed income security, which is then adjusted to take into account embedded option. Really bad definition. All right. When y'all take John's class, you need to have this discussion with them, because I've asked my friends, like, is that the right definition? So the option adjusted spread is the measurement of spread of a fixed income security, which is then adjusted to take into account an embedded option. Typically, an asset uses Treasury. Your Treasury uses the risk-free rate. The spread is added to fixed income security to make the risk-free bond the same as the bond. That's really bad definition. It's better than it was before. Because before they had it completely backwards. All right, so let's run some numbers so you can see what I'm talking about here. What did that do? One word. Right. Complex stuff, which is good, right? You should always get excited when something's really complicated. They pay you a whole lot more for understanding that. I mean, I could teach you all the easy stuff so you can get that $23,000 a year job if you want. We could do that all semester, but we're going to do the hard stuff. All right, let's say treasuries, and we're going to use a 10-year. Mortgages are actually priced off the 10-year. Why is that? Well, they're 30-year mortgages, but because they're amortizing, you pay principal interest, their duration is much shorter. So they have a duration more like a treasury, 10-year treasury than you do. They don't look anything like a 30-year treasury. 30-year treasury for 30 years, all you get is the coupon. Then end of the year, end of the 30 years, you get your principal back. For mortgages, you're getting principal and interest all along the way. So that takes that duration and really shortens it. So mortgages are priced off the 10-year treasury. Let's say the 10-year treasury is 4%. Let's say Ginnie Mae mortgage-backed security, let's say, is yielding 4.5%. All right, let's make it 7.5%. And we got an OAS. And the OAS is 0.5%. So we got to figure out what that OAS is. I've heard Investopedia has in the past said that OAS is how much more yield you're getting because of the option to pay off early. But that's not what it is. All right, so Investopedia is wrong. I even texted my friends at Victory Capital. They got this definition, so I was beginning to second guess myself. The option spread is actually 0.25%. So how much more is the bank getting because they're giving you the right to pay off the debt early? And that's 0.25%. I'm using 0.25% because the studies I've seen, they say that's how much the average is for banks to charge you because of that optionality. So what that means is conceivably, if you could go to your bank and say, hey, I want a 30-year mortgage, but I promise only to make the required payment. I will never pay extra. I won't refinance. If you did that, they should give you a 0.25% discount. But if you get to pay it off early, say, well, if we get it paid off early, we're going to charge you an extra 0.25% for that option. Okay. So what's the option adjusted spread? So let's start off with just the spread. What's the spread? 0.7. What's a better way to say the spread? 75 bips, 50 bips. So the spread's 75 bips. How much of that is the OAS and how much is it because of the optionality? So 25 bips is just because they gave you the option to pay up early. The other 50 is probably, we usually say, is this for credit risk? Well, I just told you Ginnie Mae's have no credit risk. Why would you get 50 basis points for credit risk if there's no credit risk? I remember, I loved working with Dee. She was such a perfect, she was so brilliant, PhD in math. She ran USA's Ginnie Mae fund. So obviously, that just tells you about Ginnie Mae, right? You need someone with a PhD in math to run your Ginnie Mae fund. Really smart lady. She also ran the income fund. So, and I used to just drive her crazy. I would say, hey, Dee, why do Ginnie Mae's have a positive OAS? And I would have her catatonic the rest of the day. So it's a tough question. Why do they pay 50 basis points if there's no credit risk? I have a theory. I haven't seen it in a textbook yet. Y'all can ask John Tui this question. My theory is it's not credit risk. I think it's model risk. Ginnie Mae's, because of the optionality, there's a lot of assumptions in how you measure that optionality. You have to if you do option pricing theory, you'll see there's a lot of inputs, volatility and all the kinds of things. So I think part of this is just uncertainty about how do we actually calculate all of this stuff. And so you're getting paid, so you can say model risk or complexity. I don't know, but is it credit? Probably not. There's just, I mean, the government's going to pay you off no matter what happens. That's not much different in a treasury. So, you know, got full faith in credit. I'm not saying that's what Ginnie Mae's are doing right now. I should look it up and see what a typical Ginnie Mae. I think USA closed their Ginnie Mae fund. It's a dangerous fund because people look at that 475 and say, wow, that's really good. And then interest rates do strange things. And suddenly you got these senior citizens calling in, why am I losing money on a Ginnie Mae fund? That's supposed to be real safe. Yeah, it's real safe for credit, but it's horrible for interest rate risk. All right. So the OAS is the spread the bond would have if there were no embedded option. Okay. So I've seen investigators say the OAS is how much the embedded option is worth, and that's exactly wrong backwards. They don't have that now when I look at it today, but the way they word it today, isn't that still pretty badly worded, isn't it? I mean, the option adjusted spread is the measurement of the spread. So that's pretty obvious. The spread is the spread. That helps a lot. Of a fixed income security, that doesn't help us. Stocks don't have option adjusted spreads. And the risk-free rate, well, yeah, spread's always off this risk-free rate. So that's pretty straightforward. They haven't told us anything yet, which is then, so that doesn't make any sense. It's the OAS and then it's adjusted. So I think what they mean is this spread is then adjusted. I read it that the OAS is the measurement of the spread, and then the OAS is then adjusted. But I think what they say is OAS is the measurement of the spread, that this spread is adjusted to take into account the embedded option. But not taking into account is essentially to eliminate. The OAS is to eliminate that embedded option, and what would the spread be? So I don't like how they have this worded. It's pretty horrible, isn't it? I think it's kind of really badly worded. Yeah, this whole definition is not real helpful. So let's try Wikipedia, see if they're any better. Is the yield spread, which has to be added to a benchmark to match its market price using a dynamic mark that accounts for embedded descent. They say accounts. I would not say accounts. What do I say? It doesn't account for embedded options. It does what? I say it eliminates the impact, not accounts for it. That doesn't really tell you. Accounts for, what do you mean accounts for? To me, the OAS, what it does is it gives you the spread by eliminating the impact of the option. To see if they get to that. Is a model dependent. So you see why I say it's model risk? It's model dependent. Everybody's going to get a different number. So there isn't an obvious OAS because every model is going to have a different answer. So that's why I say it could be model risk. This concept can be applied to mortgage-backed securities. The OAS of a security can be interpreted as expected outperformance versus the benchmark if the cash flows and yield curve behave consistently with the valuation model. They still haven't said it yet. The embedded option relates primarily to the borrower's right to early repayment, the right commonly, blah, blah, blah. These securities must therefore pay higher yields than non-callable bonds, and their values are fairly compared on OAS. So OAS is what you use to compare bonds. Why? Because you want to take a bond that has an option, and you want to compare it to a bond that doesn't have an option. To compare them, you got to take that option out. So if you compare two bonds, you compare their OAS, because that's telling you how much you're getting paid for the credit risk. The full spread is the credit risk plus the option that you're giving to the investor. All right. So OAS is the right number to look at. Now, if you're looking at two bonds that have no embedded options, you don't care because the OAS is the spread. They're exactly the same. All right. So the way Investopedia used to talk about it, you would think a bond without an embedded option would have an OAS of 0, but that's not right. A bond without an embedded option, its OAS is the same as its spread because that's what they're paying you for. All right, does that make sense? That's really tough, isn't it? It's pretty complex. And it doesn't help that these definitions are so, it's like they're scared to just come out and say that OAS is the spread if there were no option on the bond.
The OAS quantifies the yield premium using a probabilistic model that incorporates two types of volatilities. Still haven't gotten there yet. Now, why did it come to convexity?
Because convexity becomes real important when you have that embedded option, because so you'll usually see convexity as part of OAS.
See also, and there's other things in there. So yeah, these are not very, very good definitions at all. If you understand that though, you're way ahead of 99% of undergraduate students, because it's not really talked about much. But I do think John Dewey is going to spend quite a bit of time on it. It's a pretty important concept. You don't want to graduate, finish this class and not know what an OAS is. So it's to measure the spread of bond if the optionality were taken out, if it was eliminated. Don't say it's accounted for. I don't like that term. Does accounted for imply that's completely taken out? Doesn't to me. So it should be the credit spread, but obviously with the Ginnie Mae, that doesn't make sense. So y'all see why my question to Dee, why did Ginnie Mae's have an OAS? You can see why it's a complicated question. She knew exactly what I was asking. And she's trying to come up with an answer. I wish I could get her to come out of retirement and talk to my classes. She was great to present with. We had this one guy, Matt, and she and Matt would present. And Matt was always trying to cut jokes and all this kind of stuff. And he'd say something, and Dee was like prim and proper. It was her term, and she would say something, just cut him down. And say, "Oh, I didn't even say that." And it's so hilarious, and it's really, she's a really good presenter. She called the 2008 crisis 6 months before it happened. I remember hearing her presentation and going, Dee's really smart, and if she's right, we should be fleeing, be getting out of stocks. So I wish I'd listened to her more carefully back then. All right, so here's some numbers. If treasuries have, so MBS has a 4.5. If it didn't have the option, be 425. If the treasuries is 10, then the OAS is 15. So if it hadn't had the option, it would be yielding 425. That 425 minus 410, OAS of 15, you get an extra 25 basis points because of that optionality. Now, what's this optionality premium going to be? Well, it's going to change depending on how volatile interest rates are expected to be. If interest rates become really, really volatile, that's going to be a much higher number. If you expect rates to be really volatile, banks are going to charge you more to give you that option to prepay early. If rates are really stable, that number's going to be much lower. Now, you as the investor, you're the one that's lending the money. You want that. You're happy when that number shrinks. You don't like it when it rises, because remember, you're selling the option. When the option premium goes up, you're losing money. So you prefer stable rates. So let's get to this. So non-callable bonds have positive convexity. Callable bonds and mortgage-backed securities have low and even negative. So I think I showed you the 30-year treasury, it had like a 600 convexity number, and the 2-year had like 4. I mean, it was a massive difference. I've seen mortgage-backed securities with convexities like negative 200, negative 350. So it's radically different. So they can be very, very negative numbers. So let's talk strategy. So here's the hard part. What is your strategy? So we're talking about options. Options are sensitive to volatility. We'll learn that later in the class. We're talking about stock options. Options, when you buy options, volatility is your friend. When volatility goes up, your option price goes up. Remember, on mortgage back, you're selling the option. So volatility is your enemy. All right. So, and here the word expected is extremely important. If you expect interest rates to be more volatile, you want to buy convexity. That means you want to buy treasuries and avoid mortgage backs. Why do I say buy convexity? Because it just sounds cool. All right. You don't have to say that, but that's essentially what we're saying. You want to buy convexity. You want to buy bonds with a lot of convexity. You're expecting volatile interest rates. You want positive convexity. Remember the chart? How much the convexity it was? When interest rates moved a bunch, convexity was really, really helpful to you. All right. So if you're expecting volatile rates, what percentage do you want in mortgage backs? 0. They're going to kill you. If you expect interest rate to become much more stable, what do you want to do? Here we say sell convexity. That's kind of, again, I'm just being fancy.
you don't really sell anything, you buy mortgage-backed securities. So when I say sell convexity, you buy mortgage. Why am I telling you that? So that you can really impress them in the interview. So if you go in an interview and they say, hey, what's your juice? And you know what? People are really overreacting to this Fed. I think things are going to get much more stable. I think rates are far more volatile today. They're going to be, I'd be selling convexity in this market. They're probably going to fall out of the chair. That you would be able to speak. That's a pretty advanced way to talk about bonds. I'd be selling convexity. What are you really saying? I buy mortgage-backed securities. So think about it. Why would you do that? Well, if mortgage backs and treasuries have the exact same yield, you would never buy the mortgage back. You would just buy the treasury. All right. But if rates are really volatile right now, you're getting a much, much higher return for that option. Remember I said on average, banks charge you an extra 0.25% for that prepayment. Well, if rates are really volatile, maybe they're going to charge you an extra 0.7. So you as an investor, not as a borrower, you as an investor, you're getting much higher starting yield. And if rates are really volatile and you think they're going to settle down, you get that higher yield, you lock it in, you're gonna come out ahead. So the reason you buy mortgage backs when you expect rates to become more stable is because they have such a high starting yield. You want to capture that high starting yield, and then interest rates settle down, you're going to come out way ahead. So sell convexity, make sure in your notes, sell convexity just means you're buying negative convexity bonds. So rates are really volatile. You think they're going to settle down. Mortgage backs would be a great security. So if you think about it, let's say DD's running a treasury portfolio and a Ginnie Mae portfolio. You expect rates to get really volatile. Which one would you buy? The treasury. You expect rates to get really stable? Buy the Ginnie Mae. Do you think her investors understand that? No. And that's how she explained it. Why is Ginnie Mae down 10% and treasuries are up 8%? I said, well, volatility is much higher. And they go, what are you talking about? Yeah, that's Ginnie Mae's hate volatility. And it can be really, really pronounced. Okay, is that sinking in? If I asked you right now to explain that whole thing off the top of your head, how far could you get into it? You start off with what? There's some bonds that are just straight bonds, no embedded options. There's bonds that have embedded options. The bonds that have no options have positive convexity, and the longer the duration, the more positive convexity. That means when rates are volatile, they're going to really do a lot better than duration says. Their bonds have embedded options. That's bad for you as an investor, so you get paid an extra yield to start with. Those bonds love it when things get stable. Those bonds hate when things get volatile. Kind of see where we're going here, right? What are those options you give people? The biggest option is the right to pay something off early. You don't have to stick with the contract. All right. Questions on convexity? We'll do a team question here. Maybe next week on duration convexity. We'll see. No notes off the top of your head because I'll handle that. It's pretty advanced stuff. I love it because it gives you quite a bit of a reason for someone to pay you a lot of money if you can figure it out. All right, credit's a little more straightforward. You probably think about credit already. It's the probability someone's going to default and not pay you back. So here's pretty straightforward. The subcategories: low quality, medium quality, high quality. Pretty straightforward. High quality, that's usually governments, sovereign. You know what sovereigns are. So when governments borrow money, they're called sovereigns. So government bonds, government agencies, and then high quality corporates. I used to think of high quality corporates as the rating starts with an A. So AAA, AA, single A. Those are high quality. All right. So those are the highest quality, least likely to default. How often does a AAA bond default? Technically, it never happens. Why? Because by the time of default, it's been downgraded. So the bigger question is the transition matrix. How many bonds rated AAA today will default in the next 5 years? It's a small, over 10 years, it's less than 1%. So over 10 years, AAA bonds just do not default very often. Now, Enron, have y'all heard of Enron? So Enron's probably one of their worst cases. Enron, well, I should go look it up because my memory is I always think I remember it, but then I go back and say, wow, that was wrong. But Enron, I believe, was still AA just a few months before it defaulted. Now, by the time it defaulted, it was downgraded because they went fast. So at the time it defaulted, it wasn't AA, but it was AA pretty quickly before it. So that was one they really messed up on. But even single A bonds just don't default all that often over 10-year period. All right, so that's high quality. Medium quality to me is just all the triple Bs. So y'all know S&P and Moody's. So if I do capital A, capital A, capital A, 3 capital A's, who is that? Is that Moody's or S&P? All capitals. So that's Standard & Poor's. Standard & Poor's all capital A's. If I do capital A, small a, that's Moody's. Okay, Moody's uses big and small. I think almost all of them are like S&P and Moody's the exception. If I do capital A, that's S&P, capital A, small a, that's Moody's. If I do capital B, capital B, capital B, that's S&P, but what is Moody's? It's not capital B, small b, it's capital B, small a, small a. All right, they call it BAA. All right, so Moody's uses A's, even with the B's, and then Moody's is a capital letter and then small letters. So if you're single A, you can't tell Moody's from S&P. 1A, they're the same. All right, so CAA would be who? Capital C, 2 small A's, that's Moody's. What would S&P be? CCC, all capitals. All right. Now, Moody's can have a capital A, small a, and a 1. Y'all know what S&P has? Capital A, not a 1, but what? A plus sign, all right? So know the difference in those. So S&P uses all capitals. They're consistent in the letter, they don't switch, and they use plus signs and minus signs. Moody's, capital letters, small letters, keep the A's all the way throughout, and then they use 1s, 2s, and 3s. All right, so if you got that. So our high quality are the governments. Now governments do have ratings. S&P and Moody's do rate governments. So the U.S. government used to be always AAA, and then S&P downgraded them. So why would you downgrade the U.S. government? So that's kind of interesting, right? When you can, if you could print your own money in your garage, would you pay all your debts? Probably so. So how can a government that can print their own money be downgraded? And what S&P says, it's not the ability to pay, it's the ability and willingness to pay. And so when Congress was saying, hey, we're not going to raise the debt ceiling, so obviously they're able to pay it, but they're not willing to pay. That's why S&P downgraded them. And what did U.S. Treasuries do when S&P downgraded them? Their prices went up. That doesn't make sense, does it? But why is it? Because S&P created so much uncertainty, people bought treasuries as protections, even though they downgraded treasuries. So it's a wild story. Who understands all of that? The people here in San Antonio, for some time, they've lost this since then, but there was a point in time where the city of San Antonio was more highly rated than the U.S. federal government. And they were bragging about it. It's like, we have a higher rating than the U.S. government. That's pretty good. San Antonio was a AAA rated city, very high quality. I'm sure it's still probably up there. So credit is related to the risk of default. Risk of default means you're supposed to get a cash flow and you don't. So mortgage backs, it's not a default if you get your money at a different time you expected, as long as they're within the contract. If they pay you earlier, they pay you, as long as you're with the contract. So we're talking about you're supposed to, by contract, get a cash flow and you don't get it. That's a default. That could be an interest payment, it could be a principal payment. That's a default. So credit ratings go from high quality to low quality. For low quality, we have a special category for that. How many terms can you get for low quality? So junk. What else can you call them? How many junk bond mutual funds have you seen? I've never seen junk bond in the title of a mutual fund. What do they call the mutual funds? High yield. Have you seen a high yield? High yield is a junk bond. What sounds better to you, junk bonds or high yield? High yield sounds pretty good. The other term is below investment grade bonds. So you might hear them as junk bonds, below investment grade bonds, or high yield bonds. But high yield is the term most mutual funds use. Where does high yield start? So AAA, AA, single A, that's high quality. Triple B, medium quality, and then double B and below is junk. So triple B, double B, that's the break. So these bonds have spreads, but the spreads change as the economy changes. So high quality bonds have really narrow spreads. I should show you how much time we have.
what clock can I rely on? So I got that. I'll show you the spreads here pretty soon. Maybe next class, but high quality bonds have really narrow spreads. In fact, AAA bonds can have spreads of like 8 basis points. So the 10-year government is 4%. The AAA bond could be like 4.8%. You don't get much. Why? Because they're just high quality. And as you come down from AAA to AA to single A, you get a slightly higher spread. And then we jump from single A to triple B, it jumps quite a bit. You might get 150, 200 basis points. So the 10-year treasury is 4%, a triple B bond might be 5.5%. So you get quite a bit of jump there. And then when you get down to double B, then you get pretty hefty jump. 4 or 5%, 500 basis points. So the treasury is at 4%, high yield may be paying 8, 9%. Now in 2008, high yield spreads gapped out a bunch. So if the treasury is 4%, they were paying 22%. So 1,800 basis points. That's in a middle recession. So in a recession, spreads widen. Why? Because everybody's worried, so they want a higher return. They love the treasuries because they don't have to worry about default. So a AAA bond in a recession, their spread might go from 8 basis points to 14 basis points. A triple B might go from 150 to 300. A high yield might go from 400 to 1,000. All right. And I'll have to show you, boy, I should show you. Maybe I can show you now. Let's see. I hate hitting escape. If y'all want this spreadsheet, email me and I'll show you how to set it up. You can set this up in Bloomberg. Here's the last one I did, I think. No, there's May. How many of y'all have Bloomberg accounts? Only Ryan and Daniel. Is that because of my class, or do you have one already? Oh, I was using Capital IQ for y'all anyway.
Yeah, there's a terminal in
Okay, is it actually working? Yeah, we've had trouble in the past. All right, so I'm here. I'm scared that hit enable. So in Bloomberg, they have an index to the different type of bonds. And you can see it's a really long ticker. LF98TRUU. LU38TRUU. So you have to put that in. You put that in, you can get these yields. These are actually spreads. These are actually OAS. This is the actual OAS of these bonds. What's OAS? We should talk about that. Seems like we just did, didn't we? So it's an OAS. You already know what that is. Why is it the OAS and not the spread? Because you want to be able to compare two bonds. One has embedded option, one doesn't. So there's AAA. There's single, AA. Who's AA is that? That's a Moody's. Single A, triple B. So the average for AAA is 30 basis points. The recent low was in June of 2021, 12 basis points. Almost nothing. There are, I mentioned 8. There are AAA bonds that are below 10 on their spread. Now, who's AAA anymore? Johnson & Johnson, Microsoft, and I don't know. Y'all, someone could Google that. I think there's USAA used to be AAA. They're not anymore. But there's not many left. But Johnson & Johnson and Microsoft are the two I remember. Maybe, I don't think even Exxon is anymore. So 12, but look at the max in 2008. Isn't that crazy? In 2008, you're getting 157 basis points to buy a AAA bond. That would have been a good bond to buy back then. You would have gotten a bigger spread than you can typically get on triple Bs in 2008. That's how crazy the market got back then. Double A's give you about 83. In fact, if I were you, I would just memorize that. So you know the difference in these bonds. So 30, 83, 121, 179, and then 495. That's the average. The minimums we saw back in 2021, 12, 45, 61. Look at high yield, 268 basis points. I remember back then I was thinking, who in the world is buying high yield bonds right now? And that's just a horrible, horrible return. 268, you're not getting paid much. So that was just a horrible. And then today they're back up. They're we're still slightly, this is back in May, we're still slightly behind the average, but essentially today, or at least in May, we were essentially on historical averages. Which seems really strange, right? Because everybody's saying hard landing, soft landing, we're really worried. And yet the corporate market's saying, no, everything's normal. So I find that kind of interesting. The bond market's kind of telling you, no, it's not as bad as people are saying. So, it's kind of, I don't know what today, I could update this today. How do you update it? Well, all you have to do, see this formula in here, BDH, Bloomberg Data Historical. All you have to do is go to Bloomberg machine, you load this file, and everything's updated automatically. You don't have to do it. It just pulls all the data in a nanosecond. Pretty cool stuff. How far back can you go? Well, I've got 353 days or weeks. These are months. 353 months back to 1994. You can do this daily, so you can go back to 1994 and get daily yields. I didn't want to do that; it's just too much data, but you can dump a lot of data from Bloomberg. I remember one student was keying data. He had this model, and he told me it takes me 24 hours to do this. I said, why don't you just link it to Bloomberg? And the next week I saw him, and he was like, yeah, I went from 24 hours to 30 seconds. So all the data just dumped in. It's pretty amazing stuff. So yeah, if I were you, this kind of stuff I'd be carrying in my wallet. Just so you can, especially if you're interviewing like with Victory Capital, knowing what a normal spread is, for them, that's just top of their head. And fixed income people talking spreads. So I remember my office used to be right next to the trade desk. And I remember the fixed income people coming over, they didn't say I wanted 4.2%. They come over and say, I wanted 15. And the traders say, well, I can only get 12. No, I wanted 15. What are you talking about? 15 basis points, the spread. They only talk in spreads. They don't say I want this interest rate. They say I want this spread. And they don't even say bips. They say, did you get it at 50? No, I got it at 45. Well, what happened? I wanted 50. 50 basis points. In fact, it's real embarrassing to him, like USA borrowed money for the first time in its history. And I was the only person in the department when the chief treasurer came out of his office. He was so excited because USA got a really good rate. He comes out and said, Ron, we got it at 10 over. So that's great. You got what at 10 over what? 10, what is 10? I had no clue. He looked at me like, why did we hire this guy? And I was like, sorry, you probably shouldn't have. But I didn't, it's kind of in my defense, I have no idea what he's talking about. I haven't been involved in that project at all. It wasn't my department. But he was excited. He just said we got it at 10. He didn't say we got our borrowing rate at 10 basis points over the risk-free rate. No, he didn't say all of that. He said we got it at 10. That's just the way you talk. So if you're going to interview with Victory Capital, you don't even have to say bips. Say I was looking for 50 over. You don't have to say 50 basis points over, but this is the way. They're strange people. Right. Any questions on that? Y'all get a picture of that? If you want the spreadsheet, maybe I'll put the spreadsheet out there on Canvas. But you have to have you don't have to have a Bloomberg account to look at the spreadsheet because I copied and pasted his values. But to update it, you have to be on the Bloomberg machine to get that to work. And this is the kind of stuff you should know. So I think it's really important as an undergraduate and when you're interviewing, what's normal and where are the extremes? So you can see the extremes there. I gave you the 10th and the 9th percentile. So 700 basis point spread at high yield is a pretty extreme number. That's only 10% of the time is it higher than that. You can see what I was talking about, the 1833 and 08. You're getting 18% over treasuries to buy high yield. In high yield, if you bought them there, you would have made 70% in 2009. Spreads came in and they made a fortune. So knowing the norms, and then what else you need to know? Where are we today? So if you interview with Victory Capital, they'd be pretty impressed that you know spreads are slightly below historical normals, pretty close. And then you could actually quote these numbers. So they're good numbers to know. I'm not saying you memorize this entire matrix, but if you have it in your wallet, you could probably slip it out on your lap and read it while you're talking to them, and they wouldn't be none the wiser. So it is funny talking to some college students that aren't too involved in their finance major, and I'll say something that's really shocking, and they're like, "Oh, that's interesting." Like, no, you should have fainted. You didn't think. Why didn't you think? That's like a really big deal. But no. All right. So credit spreads are their widest in a recession like we saw in 2008. they're at their narrowest, they're in a strong recovery. If you own a bond and the spread widens, that's gonna hurt you. Because that the spread rising means that interest rate goes up, so the bond prices come down. If the spread narrows, that's gonna help you, because that means the rate's gonna come down. So we measure credit risk the same way you analyze a stock. Financial analysis. What's their liquidity? What's their margin? What's their turnover? Their times of concern, their debt to EBITDA, all the stuff you do with a stock, you do the same type of analysis for a bond, except for with the bond, your main focus is, are they going to be able to pay us off? So you're more focused on the extreme. What's the worst thing that can happen here? With the stock, you're looking at growth. What's the best thing that can happen here? Much more positive, but the analysis is very similar. So you're doing finance analysis, then you have credit ratings. So if you go to Victory Capital, they use credit ratings, but they have their own internal rating. And what they're looking for is when they strongly disagree between the two, and so maybe they'll get a better spread. So maybe they think this bond's really a single A bond, but it's getting rated triple B, so they can get a triple B spread for a single A bond. That's going to be a good investment. Or the whole bond market knows that, and so there's no opportunity there because everybody else is seeing that as well. So that's the kind of thing kind of analysis you're doing, but they definitely look at Moody's and S&P. You're probably not going to have a bond double A and Moody's has a double B. You'd have to be seeing something pretty wild to see that kind of difference, but you might see it. I mean, the key is on the, I remember John, not John here, but John that works at Victory Capital, he used to call them cuspy bonds. You know, triple B minus or Baa3. He says right on the cusp being high yield. And he said, or double B plus, right on the cusp being investment grade. He said, those are the most interesting ones. Because once you figure out where they are, it's gonna make a big difference. Because once you drop from investment grade to below investment grade, it's not just they become riskier, but their investors all change. It's an entire different market. So people who buy investment grade can't buy high yield, and people who buy high yield don't want investment grade. And so it's really interesting when GM got downgraded. GM was massive. They're the biggest bond out there. They went from investment grade to below investment grade. Well, the investment grade people had to sell it. The high yield people are like, okay, this is the biggest bond in the market. We better own some of it because if they recover, it's going to look bad. But it's so massive, we can't buy it. So that caused a huge problem in the bond markets. But you do have different buyers and sellers. So it's not just like it got downgraded. It gets downgraded. These people all have to sell it. These people are probably going to have to buy it. It's going to create quite an interesting conundrum. And it's going to happen mainly in those triple Bs and double Bs because you're kind of moving between those two. All right, so there's the categories, high quality. These are going to have the narrow spreads. So remember, the spread is risk-free rate plus your risk premium. We call it a spread. In stocks, we call it a risk premium. For bonds, we call it a spread. Medium quality, there's your Moody's, there's your S&P. And then low quality junk bonds. The D is the easiest because D means they defaulted. So just think of D for default. None of the other letters quite work that way, but D for default. You see someone as a D, does that mean no one wants to buy it? Well, yeah, there are people who buy them. There's actually hedge funds. They're called distressed debt. Have you heard that term before? Distressed debt investors, they buy these bonds that look like they're in a lot of trouble. So, you know, Puerto Rico had well, I wish I could show you when Hurricane Maria hit, Puerto Rico's debt dropped dramatically in price. And then President Trump went to Puerto Rico and kind of hinted that we're not going to help you out, and the bond dropped again. So it's like, thank you, Trump, for visiting us. It's like they had two hurricanes, Hurricane Maria and Hurricane Trump. But he said the worst possible thing you could have. And you can see it. Bond price drops, Trump drops again. So you say, why would you loan them money? Well, if they have a bond, you can buy 20 cents on the dollar. You don't need it to go back to 100 to be right. If they can just pay 50%, you go from 20 to 50, you're going to make a big return. So you don't have to see, are they going to make all their payments? You got to see, can they at least make 20% of their payments? And they'll still do well. So it's an analysis not of can they pay, it's how much can they pay. So you can buy these distressed debt securities. These are often referred to as hybrid securities because they tend to look like both bonds and stocks. Because if a bond defaults, the stockholders are wiped out and you essentially become the stockholder now, even though you're a bondholder.
The stockholders are gone. Now you're the owner of the firm because they defaulted. You now own everything they have. So they're somewhat hybrid securities. They did horribly in 2008. And they were up 70% in 2009, which is the same thing the stock market was up. So they look just like stocks in 2009. Preferred stocks, we won't spend too much time on them, but they're another hybrid security. They're kind of in between stocks and bonds, but they're really more a bond portfolio. And they're different qualities as well. There's high quality preferreds and low quality preferreds, so they're kind of all over the place. So the low quality is going to have the widest spread because they're the highest risk. All right, so the tactical here gets too complicated. All right, so let me just tell you what we got to do next Tuesday because it's complicated. So when a recession, spreads are going to widen and recovery spreads narrow, but there's a correlation between recessions and recoveries and the risk-free rate. What does the risk-free rate usually do in a recession? What's the Fed doing in a recession? Cutting rates. So in a recession, the risk-free rate drops. So the risk-free rate drops, but the spread widens. So does the corporate bonds price go up or down? You don't know. If the risk-free rate falls 100 basis points, but the spread gaps out 50, the bond price actually will go up a little. If the risk-free rate falls 100, but the spread goes up 200, the bond price is going to fall. You're going to really underperform treasuries, but you don't know if you have a positive or negative return. So you have to have kind of two things in the mind. In a recession, risk-free rate falls, spreads widen. Recovery, risk-free rate rises, the spreads narrow. So corporate bonds kind of have two things going on. They're kind of self-diversifying. It's kind of like an asset that's diversifying you yourself. You have a risk-free rate in there. You also have the spread. They're kind of moving opposite directions in a recession. So we'll have to look at it that way. So we'll stop it there.